that Bill Dudley said this Fed is lost, and I think that is the case. They don't have any idea what's. You really can't believe or take seriously anything that they projected today because they don't know. This stuff has a half-life of the next tweet. So at this point, the Fed is just trying to reassure the country, which probably explains what we're seeing in the markets today, is that Jay Powell sounded like he was reassuring, but I wouldn't take any message out of this. Everything that he said after good afternoon, I would sort of put to the side.
What did you make, Mike, of his complete dismissal of the University of Michigan sentiment survey?
Well, that's a kind of standard thing for Fed officials. The old, we watch what they do, not what they say. And people have, the inflation numbers in these surveys have been distorted a lot in the past because people don't really have a good handle on what the inflation rate is. They just know their grocery prices are going up. So I can understand why he said that. And it was just a 1 month move in the longer run. The shorter run has moved up for a couple of months. So I think this is maybe a little whistling past the graveyard in terms of not trying to give the impression that the Fed is worried and going to have to take some action.
Mike McKee, appreciate the updates. Looking forward to your coverage throughout today and into the weekend as well. Lots to process here. Equities up nicely by 1.2% on the S&P 500. That bounce continues. With us around the table to close things out, Amanda Lynham of BlackRock. Amanda, where to begin? It's a lot to process here. One thing we haven't talked about enough, and Lisa mentioned it coming into the decision, a reduction in QT. How important is that to this market?
Well, good afternoon. Thank you for having me. Two things jump out to me. One is going back to the growth inflation mix being more challenging. A lot of this was baked in heading into this expectation. And so I think that's part of why we're seeing the market reaction. We've had just such a bruising few weeks in the equity market. Most forecasters have reflected a lower growth and higher inflation. And I think that's part of what's driving this here. And I would just underscore something that Bill Dudley said, which is I think this just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. And so really that 1.7% growth in the SEP, slightly below trend, that really has to hold up for risk assets to validate this move because the Fed's telling you that they can't respond. As it relates to QT, I think maybe that's why you're seeing some modest relief in longer end yields in the bond market. I think on the margin that could be somewhat helpful versus the counterfactual, but I don't think it's the main driver. I think the main driver here is that a lot of this bad news was baked in heading into this expectation. A more challenging growth inflation mix is the base case, and I think it warrants some widening in credit spreads.
Do you think it's positive that he resurrected the transitory word?
I think it was accompanied with a healthy dose of we're not quite sure what's going on.
Was absolutely
yeah, so I think the market is kind of looking through that. But from my perspective, his kind of reinforcing that the labor market is still in a solid place is to me the key thing. Because if you think what's driving the resilient growth that we've seen over the past few quarters in the U.S., it's the consumer in aggregate. If we have a higher layoff rate, so if corporates start to be concerned about margins, they flex that layoff tool more aggressively, which is still quite low. That's a situation where that weakness that's so far confined to the low-end consumer could extend more broadly. So what to watch? Micro-level commentary, high-frequency data on the labor market, capital markets functioning, right? Like the idea that corporates can issue just at a higher cost, that's fine for market functioning. I think where the Fed starts to get concerned is if the markets are frozen.
There's also this question of the long end of the yield curve and why it should go down if this Fed is biased to looking through any inflationary shock as simply near term, if that is their base case, and we will not know for a longer period of time. Does that raise concerns about longer term entrenched inflation, especially at a time of global fiscal releveraging?
Absolutely, and I think our base case is that longer end yields are structurally higher, right? So that's the view across a variety of platforms at BlackRock, and I think right now, what we're seeing is that treasuries are not a reliable hedge in risk asset underperformance. And so what you've seen to a certain extent, treasuries can rally when there are growth concerns, but it kind of peters out at a certain point. And really, for rates to rally significantly, you actually need to have more valid recessionary-like concerns. You can't just have a growth slowdown. So what we're seeing is that it's almost like a quasi hedge, but it's not a firm hedge. Inflation expectations, I I do think it is concerning that they're not expecting inflation to get back to target until 2027. Similar message from the ECB, frankly, where President Lagarde said it's going to be a further path. When you think about the spillovers of German fiscal spending, right, higher bond yields, these markets don't operate in a vacuum, right? So equities versus credit or Europe versus US. And so I think we are bracing for structurally higher rates and structurally higher inflation.
If we have 1.7%, and if we get the x-axis wrong and it extends, that tells me Republicans get tossed out of Congress, just as one talking point. And there'll be huge pressure. Does it just devolve down to price up, yield down, and we go through 4%, as Bob Michael told us before the conference?
I think so. I mean, I think you asked earlier the unemployment rate that's really problematic for consumer credit. 5% is the metric that we're hearing that things really become problematic. But I think on the way to that journey, so when you start to get to 4.5%, I think you start to get concerning. It's the velocity of that move, and often these are nonlinear, right? So the deterioration happens quickly, as we've seen in prior cycles. I think that is very concerning. But to me, it really just hinges on, Chair Powell mentioned a low hiring, low firing environment. If that firing picks up, that's really problematic.
That's exactly where I wanted to go. Tomorrow morning, 8:30 Eastern Time, jobless claims drop. Help me understand the scenario. If we start to see some weakness there, how will markets respond to that? How will we think about the Federal Reserve's response to it?
I think markets have front-loaded it a bit. You've seen some widening in credit spreads. European credit is still holding in well, so I think that points to the U.S. concern. From my perspective, the Fed, though, is somewhat constrained in how they can respond to that, given the inflation backdrop. So I think that's why the deterioration in the growth backdrop is so important to monitor, and it's also probably more critical than it was even a few months ago, because a few months ago, the expectation was inflation will continue to cooperate. If further progress on inflation is delayed, then you somewhat have one hand tied behind your back in terms of I guess the question is, how much of a growth deterioration needs to occur before the Fed can react? And it seems to be that the bar is pretty high for that.
That's another way of saying bad news is bad news. If it is bad news over the next few weeks.
Especially when accompanied with even near-term inflation, I'm just struggling to understand what kind of offset they can provide by cutting rates at a time where inflation is a concern. I just keep going back to that. And this question about how supportive that will actually be. I guess that if the news is bad enough and they cut rates, it'll still be bad, but you also might get a little cheaper borrowing costs.
This goes to the wait and see. Confidence was a word that came up in that news conference. How long before you have any confidence? I'm not sure anyone can have any confidence right now. How long do they have to wait before they see?
Well, that's what I think makes the high frequency data so valuable. And as we saw during the pandemic, it was the company commentary that actually shined the light on how pervasive the supply chain disruptions are. I think this just underscores the point. You have to be invested for a wide range of growth, inflation, and policy outcomes. All right, so it's not even just the growth inflation mix, it's the policy mix. So incorporating floating rate exposures, real assets, inflation hedges, those are all things that are really valuable, because I think there are just so many paths on this probability tree that we really have to position for all scenarios.
When we were coming into 2025, there was this belief that we have on one hand a Fed put, and on the other hand a Trump put. Trump put still out there as sort of a question mark. The Fed put, people are saying, well, maybe they're going to be willing to step in. Can we really frame the issue in that kind of way? I guess that's sort of the fundamental question of today, where the market's treating a dovish response from the Fed as being positive for risk assets. Is that the new paradigm? Is it the old paradigm?
Yeah, the one thing that jumped out to me from Chair Powell's comments, previously he had talked about that they would respond to an unexpected weakening in the labor market. If the now base case is 4.4% unemployment, then it seems to me like you'd actually have to have something beyond 4.4% unemployment to step in and respond to that. So I guess it's saying that the bar is actually high, because right now they're telling you that they're expecting some weakness in the labor market beyond that.
Unlike the three of us, you went to class on Friday at Villanova years ago. We remember this well. When you study stagflation or hints of stagflation, there's a point where every central bank has to choose price change, finance, or jobs, jobs, jobs. I see no indication of anything, but they're going to capitulate to a higher unemployment rate down the road and ignore the rate markets. Is that the way you read it?
I mean, I think that's what their forecasts are telling you, is that they're baking in some deterioration. And so what does that mean for risk assets? A stagflationary environment is unquestionably negative for risk assets, because in that scenario, you have a bit of a double whammy of wider spreads and higher rates.
We don't do logs this late. We've all been up since 5 a.m. or 4 a.m., but the answer is it's nonlinear, is it? That's really what we're talking about. I think that's right. And that wasn't in the press conference.
I think that's right. And I think when you take a step back, yes, we've had some widening in credit spreads, but all things considered, we're still really tight tight. And so we're baking in an expectation for an ongoing rebuild of risk premia. So I think the market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity. And I heard your conversation with Bob earlier. There is a lot of demand on the sidelines, so I think being opportunistic is really the key to taking.
You're seeing the same thing? How much appetite is there for fixed income?
We are, and I think I would say save for the lowest quality pockets of the market, where, for example, CCC interest coverage is still below 1x, and so that's a very tenuous place. But foreign demand, yield-based demand, long duration spread product, high quality spread product, the U.S. is the largest, broadest market for that, and so there is a significant amount of demand. But I do think there needs to be a rebuild of risk premia, given this is unquestionably a more challenging growth inflation mix.
Where is that money coming from? Does it come at the expense of risk assets like stocks? And I speak at a time where Howard Marks of Oaktree came out and said he prefers credit right now over an equity risk because you are getting income and you have a greater degree of certainty.
And you're higher in the capital structure. And I think maybe one of the understated themes of the past few quarters or maybe past few years is that corporate bonds, because of the higher interest rate, are throwing off more cash just on an ongoing basis. And so just reinvesting that cash is something that's important. Foreign demand has been a big tailwind. I will say on the margin, we are bracing for some of the foreign demand for U.S. dollar credit to, over time, perhaps be repatriated back to European markets now that European yields are quite attractive. And so on the margin, that's something to watch for. But again, these risk assets don't happen in a vacuum. But I do think there's a significant amount of demand, whether it's coming from equities, it's coming maybe from different parts of foreign markets.
I mean, one thing we haven't talked about here, we got BlackRock on the desk here. I mean, John, it's just simple. BitDog, moonshot, out to 85,000. I mean, these are the indicators that technically it's not telling me anything, but I'm sorry. You're going 78,000 to 85,000.
Gold signals something too. What are we seeing there from crypto, from gold?
I think that's diversification. I think that's the market saying that perhaps...
come on, it's fear.
I think the gold is perhaps central bank buying, some other dynamics going on there, but I think a big part of it is portfolio and real assets, inflation hedges, uncorrelated exposures.
Oriental rugs?
The stagflationary backdrop that we suggested, the 60-40 portfolio wouldn't fare that well in that sort of...
That sounds personal.
She's a machine. I
that
love
sounded personal. Who's been forcing you to buy rugs?
I'm looking at this. I don't have any technical veracity on Bitcoin.
Wait, is that hold on a second, pause. Is that your Haven trade? Oriental rugs?
My Haven trade is tuition. Okay, let's leave it there.
Finally found out what's happened with a triple leverage cash fund. It's been going to rugs.
Oh my gosh.
I just upset BlackRock. I was in syndication with them. They wouldn't go for triple leveraged all cash.
Amanda, appreciate your time. Fantastic. What a moment. Amanda Lynham there of BlackRock. Perhaps we're being fast and loose with the S word, stagflation. We're looking for growth close to 2% and inflation anywhere between 2.5%, 3%. But it's the mix. And this is what Amanda was talking about. The mix here. This is the challenge the Federal Reserve is facing. It is the central banker's dilemma. Typically, the kind of dilemma you see in emerging markets and not in developed markets. Downside risk to growth, upside risk to inflation, and a Federal Reserve uncertain, low on confidence, and not sure what to do.
And that's the reason gold is really telling us something. And that is this real question about whether the United States, with the policy mix and the monetary policy backdrop and inflation where it's coming from, can avoid a stagflationary-like spiral, not necessarily stagflation of the 1970s, but an environment that makes it more difficult to repay a debt load that's causing a lot of concerns for a lot of people.
Peter Fisher taught me this. Get your hands out. He says, on radio it doesn't work. We're going to go with this. The answer is here on a nominal GDP basis. Today, the lower growth was balanced out by stagflation to a pretty much level nominal GDP. What happens to Amanda Lynham's call if we get nominal GDP to begin to compress? That's what's not in the discussion.
I'll tell you what this market's doing for the benefit of our TV audience, like this, up and to the right. Just sort of up and to the right. That's the story today. We'll see if this holds. We are positive by 1.5% on the S&P 500. Going into the closing bell. Coming up on the close, the team's going to take it over. They'll be catching up with the former Fed Governor, Betsy Ju. From New York City this afternoon, good afternoon to you all. Thank you for choosing Bloomberg. This was Bloomberg Surveillance.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. 14 minutes to go ahead of the closing bell on Wall Street. You heard Jonathan Farrow say it, up and to the right. The Dow, the S&P, NASDAQ, all very close to session highs right now, right to the numbers, with the S&P up 81. Fed Wednesday up 1.5%, 56.95 where we stand. The Dow surging 497 points, up 1.2%. The NASDAQ Composite Index up 1.8% with a 10-year 4.25%. The 2-year 3.98%. Gold up $11 the ounce. 3,046 right now on the precious metal, up by about 0.4%. Crude up 0.6, 67.28 a barrel on WTI, and Bitcoin now up 4.1%, 85,403 on Bitcoin. The big story today, you heard it live on Bloomberg. Fed officials held their benchmark interest rate steady for a second straight meeting, though they telegraphed expectations for slower economic growth and higher inflation. Here's Fed Chair Jay Powell from the statement.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
Fed Chair Jay Powell again live on Bloomberg Radio. So recapping, we've got the 10-year right now 4.25%, the 2-year 3.98%. Stocks higher heading into the close, with the S&P right now up 79, up by 1.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
And a very good afternoon, everybody, live on radio, TV, and Bloomberg Originals, also YouTube. Actually, we're going to be on TV in just a moment. We're going to head over to our TV colleagues. I'm Carol Massar at Bloomberg headquarters in New York City. And, of course, Tim Stenovec, you're out there on the West Coast.
Hey, you're on a TV here, Carol Massar. And if you're watching on YouTube, you can watch us on TV if you want. What a Fed meeting.
Yeah.
What a market reaction.
Well, listen, I think it's so interesting to hear the conversation that the gang, the surveillance gang, really just having on television and radio about, was it hawkish, a little bit hawkish? Was it dovish? We certainly saw equities rally. We're coming off our best levels of the session, but nonetheless, Tim, we did see that immediate market reaction. Stocks moved up. We saw yields back off. I feel like I can't wait for the May meeting already.
Yeah, I'm already looking forward to that. And we're going to get a lot of data between now and then, too. Carol, as we heard from Charlie, the Fed, as expected, held their benchmark rate steady for a second straight meeting, though they telegraphed expectations for slower, Carol, economic growth and higher inflation.
Did indeed. Jay Powell saying the U.S. economy, folks, it is strong overall, and yet there are some signs of moderation.
Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment.
That, of course, was Jay Powell at the press conference today, a little bit earlier. As for market reaction, as we mentioned, we did see stocks rally and U.S. Treasury yields back off right after the decision. Let's get more, though, on what we heard from the Fed today and what we saw in terms of market reaction. Keep in mind that we're going to be covering all of this over the next hour and a half. With us is Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey and Veronica Willis, Global Investment Strategist at Wells Fargo Investment Institute. Ira is at BI headquarters in Princeton, New Jersey. Veronica is in St. Louis. Hey, Ira, I want to start with you. How did the Fed do, you think, on messaging and in assessing today's current U.S. economic backdrop and what it needs in terms of monetary policy? And I am curious, did it feel more hawkish? Did it feel more dovish? What was your read?
So, well, we have a natural language processing model that parses all the words and language from all of the opening statements, and this one was incredibly neutral, and it had been somewhat dovish, and being as neutral can be, it was a little bit surprising maybe to see the Treasury market rally a little bit and also bull steepen. So before the Jay Powell started to speak, Treasury yields were higher by a little bit on the day, and then we rallied about 10 basis points in two-year yields, soon after he started to speak. So the market certainly took him as dovish. He wasn't hawkish by any stretch of the imagination. The one thing that I think is interesting is the dot plot, and we thought that maybe the median dot would move down a little bit. It didn't. It stayed the same. So this is pretty unusual for the market actually to rally like it did, or the rate market to rally like it did when the Fed didn't move the dots.
Well, Ira, I wanted to talk a little bit about that because there was any certainty with regard to the Federal Reserve's economic outlook. We heard as much from Mike McKee on Bloomberg TV and Bloomberg Radio a little earlier. The Fed doesn't really know where we are. Why does the market think it knows where we are?
Well, the market has to price something, right? So I think that the market probably took what the Fed said, not so much that that they're necessarily the Fed's going to be hawkish or dovish, but I think one of the things is that the market might be thinking, hey, the Fed might make a policy mistake here because we are seeing a slowdown, but the Fed and the Fed dots are suggesting they're not going to cut rates very quickly, and certainly not in the near term. And you really saw that rally pick up after Jay Powell mentioned once again that he thought that they could that they could be patient and they didn't have to be in a hurry. I mean, the exact words were, "We're not in a hurry to make a rate adjustment." So that means we're here probably for another 3 to 6 months at least on the Fed funds rate.
Veronica, I want to bring you into this conversation. In terms of markets, we've just been talking about this with Ira. I mean, we certainly did see equity markets rally. We're off our highs of the session. What's the investor read on this decision, Fed commentary? Do you feel like investors have it right? And has anything that we got from the Fed chair and from the FOMC today in its decision and commentary and revised outlook, has it changed your investment outlook?
I think that investors are really looking at the kind of best case scenario where growth is going to slow enough to afford the Fed to do, 2 or more cuts this year. And I think that's a little bit too optimistic. So the market may have been a little bit too optimistic today in response to this data or in response to what the Fed has said. And I think that it's, more realistic to expect maybe 1 cut this year. And I think that the risk is a little bit more on the side that there might not be a cut this year versus 2 or more cuts. So I think it's just another example of the market kind of taking what it wants from what Powell says, taking what it wants from what the Fed has shown us, and hoping for that best case scenario.
I mean, what was the most important part of what we got from the Fed chair, Veronica, in your view today?
Yeah, I think what was really interesting were his thoughts around the consumer and how that might impact future economic data. I think that's something that's becoming more and more. Watching really closely all of these sentiment surveys that have come out with consumers feeling uncertain about their ability to continue to spend. We haven't necessarily seen that flowing through very strongly in any of the hard data, but it's something we're watching very closely, and I think it's something that the Fed is watching very closely as well.
Hey, Ira, come on back in here. Given what we heard from Fed Chair Jay Powell today, and we think about sort of economic data that we get, what is the next catalyst that you have your eye on?
So, we're like in this weird place. So we do get the PCE deflator next week. And, I'm not sure that that's really going to matter a whole lot because we kind of know what it is, given we've gotten the inputs to that. So it's going to wind up being things like some of the survey data, the ISM data that we get in 2 weeks, plus the payroll report, obviously, is the big one. I think something else that's going to be interesting is the implementation of the slowing of runoff. So, it hasn't gotten a lot of attention, only had one question at the very end of the press conference, but the Federal Reserve is again having the amount of quantitative tightening it's doing, and it's only going to have about $20 billion of runoff come April 1st. And I think that that's something that is kind of flying under the radar, and how will that affect liquidity in markets once that's implemented, I think will be an interesting thing to look out for.
Are you already looking forward to the May meeting, Ira?
I look forward to every meeting, but we got the minutes between then. The minutes will be really interesting because there was a lot to unpack in this meeting. So the minutes could be really an interesting read when we get them in 3 weeks.
I was going to say, Carol, boring as you and me, where we're just like already looking forward to the May meeting. Hey, Ira, before we let you go, what was one question that you didn't get answered from Jay Powell today?
Yeah, I think it was a little bit about about the balance sheet and how they see the balance sheet reacting with the economy. He has been asked that before, but it's been a little while. And given that they did take action today by slowing the pace of asset runoff, that I think that can be pretty important. And he wasn't asked about the other side of the balance sheet, right? So the asset runoff occurs, and then eventually we're going to have a time when there's not enough liquidity. And we know that there's been issues with the standing repo facility and some of the ways that they conduct liquidity activities and actions. And he wasn't asked at all about that either. So I would be really interested to, kind of dig into those weeds, because this is the plumbing of the entire financial economy that we have. So if the financial economy, the repo market, and the funding markets break, everything else comes crashing down, as we saw in 2008, right? So we have to make sure that the Fed has the tools in order to handle that once we get to the lowest comfortable level of reserves.
All right, we're going to leave it there. So much appreciate both of you and your views on all of this. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey and Veronica Willis, Global Investment Strategist at Wells Fargo Investment Institute. Our thanks to both of you as well. Obviously, our big story, what the Fed did and what's to come and how the markets read this. Right now, though, folks, just got about 2.5 minutes left in today's trading session. Heading over to our TV colleagues. The closing bell starts right now.